Welcome to our comprehensive guide on understanding yield and how it impacts your investment returns. In this tutorial, we'll walk you through the various aspects of yield, calculation, different types of yields, and how you can leverage this knowledge to make informed investment decisions. Let's start with the basics. What is yield? Yield refers to the earnings generated and realized on an investment over a particular period, expressed as a percentage based on the invested amount, current market value, or face value of the investment security. For example, if you invest $1,000 in a bond that pays $50 in interest over the course of a year, the yield would be 5%. Now let's delve deeper into the two primary types of yield: current yield and yield to maturity, YTM. Current yield is the annual income, interest, or dividends divided by the current price of the security. For simplicity's sake, let's consider a bond with a face value of $1,000, an annual coupon payment of $60, and a current market price of $950. Using our example, the current yield would be 60/950, asterisk 100 equals 6.32%. Yield to maturity, YTM, is a more complex calculation as it accounts for the total return an investor can expect to receive if the bond is held until maturity, including all coupon payments and the return of the bond's par value at maturity. To calculate YTM, you need to solve the following equation where YTM represents the yield to maturity. This equation can be complex and is typically solved using financial calculators or software tools. For our example, let's assume we have all the necessary inputs: a bond with 5 years until maturity, an annual coupon payment of $50, a current market price of $950, and a face value of $1,000. For simplification, we won't walk through the entire math, but let's consider the YTM to be approximately 5.45%. Now, let's look at dividend yield, especially relevant for stock investors. Dividend yield is calculated as the annual dividends paid by a company divided by the current price per share. For example, if a company pays an annual dividend of $2 per share and its current stock price is $40, the dividend yield would be 5%. Using our example, the calculation would be 2/40, asterisk 100 equals 5%. A practical question might be, why is understanding yield important for investors? Yield helps investors compare the potential income returns of different investments, making it easier to choose the right one for their objectives. For instance, if you have the choice between two bonds, one with a current yield of 3% and another with a YTM of 3.5%, understanding these metrics can help you decide which bond might be a better investment based on your income needs and investment horizon. Let's answer some common questions. First, what is the difference between yield and return? Yield represents the income earned on an investment, while return includes income plus any potential gains or losses in the asset's value over a period. Next question, how does inflation impact yield? Inflation erodes the purchasing power of the income from investments. Therefore, it's important to consider real yield, which accounts for inflation, when evaluating your returns. Finally, are higher yields always better? Not necessarily. Higher yields can be indicative of higher risk. For instance, a high dividend yield might signal that a company's stock price has fallen significantly or that it might not sustain its dividend payments. In conclusion, understanding yield is crucial for making informed investment decisions. It involves not only the income from an investment, but also other important factors like the investment's market price, face value, and inflation. Remember, always consider yield in the context of your overall investment strategy. Thanks for watching, and don't forget to check out our other tutorials for more financial insights.